and what led me to where we are now. So I started trading when I was a young lad many decades ago, more decades than I care to remember or acknowledge. I was, I think, a sophomore at university. I was going to one of the finest universities in the United States, the University of Southern California, private business school. And I was learning, how to run a business, how to evaluate businesses from investment standpoints. And everything was based on what we call fundamental analysis. So I was taught to dissect an investment, certainly in stocks, by looking at a company, looking at the price earnings ratio, the sales inventory ratios, the management, and what we call fundamental metrics, balance sheets, cash flows, earnings, EBITDA, all things that we would look at to evaluate an investment. And right around that time, my dad was doing business with this investment banker. His name was Graham Loving. You couldn't make a name like that up. He wore a patch over one eye, and he was a pretty idiosyncratic character, but a very brilliant man. So in addition to his day job as an investment banker, at that time he was actively trading the commodities futures markets. Everything from orange juice to pork bellies to live hogs to soybean meal to gold, silver, platinum. Now, this was also a very special time in the commodity markets, which is very much resonant with what we're going through today. This was in the late 70s, where we got a bout of inflation that we're experiencing today. And we saw that inflation flush into the markets. And so, he was trading 20 markets on the go at one time. And I never understood how he could understand all of these markets in order to make these decisions and capitalize on these opportunities. But what I learned was understanding is kind of anathema to investments. If you try to understand something in real time, the markets are really a discounting mechanism. So instead of trying to understand what was going on with Ghana exports in the cocoa market or a freeze in Florida for orange juice, Graham was just plotting the price movements on a piece of graph paper. So this again was a time before we had fancy charting services or things on the internet where we could evaluate things in real time. He basically got a piece of stationary graph paper and plotted an X and Y axis. So he plotted price and time. And then every day he would just plot the closing prices of live hogs and soybeans and corn and wheat and, hogs and, anything you can imagine. And over a couple of weeks, the lines would either be going up or the lines would be going down. And he'd say, Mark, I'm looking to buy something that's going up and sell something that's going down. And to my simple way of thinking, that's really resonated with me. And then I went, to see Graham make an inordinate amount of money. My dad put in $50,000 in an account. Graham put in $450,000. So in about 1978, 1979 timeframe, they put in $500,000 in a commodities account for Graham to trade. And by the end of the year, that account was worth $5 million. So these were numbers that, would dazzle anybody, certainly as a young, influential person about to embark on a career, wondering what the hell they were going to do with their life. I was watching Graham and other people I knew in the commodities markets make this money based on just understanding of the movements, what we call technical price action. And so this is, again, in contrast to fundamental studies where we try and break apart an investment and understand every piece of it. Now we're just looking at price simply to make a market decision. And very often I'm asked, even when I explain it in detail, do I look at the news? And the short answer is no. Especially in these times, you've got so many countervailing themes. You've got inflation, you've got interest rates, you've got the Fed, you've got how much more tightening is the Fed going to go? What is that tightening going to do? Are we going to go into a recession? If we are, is it this year, next year? And all of these things. And if you try and think about these things and evaluate these things, it's very unlikely that you will make money in the markets. Everybody thinks, well, if I was just an MIT economist, if only I had this information. I'm going to show you how I make boatloads of money on not knowing anything. And that's really my objective. And it's much harder than you would think. So, I would like to be ignorant, but the challenge we have today is that we have so many streams of different things coming at us. We've got the crawl on the TV, you've got forums, you've got analysts on TV shows like I've got behind me here, and you're hearing all kinds of stuff. So I listen to this business channel all day long, and every few minutes they've got some guy saying I'm bullish and the next guy saying I'm bearish. And if you listen to all that, you can go crazy. But the answer is right in the market. My saying is the market is always right. I'm often wrong, but the market is always right. And so what I'm going to try and do is share with you how I evaluate opportunities, how I capitalize on monster moves in the markets, only using price information, price patterns, price action, price trends, to see where things are going and how to set up risk reward opportunities. So the thing is, even if we did have all of this information, even if we knew there was going to be a recession next year, it would be of almost no value. Because, in the meantime, if you have a sharp rally and are wiped out before, you're correct, it doesn't help you. So the market really comes down to, unless you're Warren Buffett and your holding period is forever, then it really comes down to analyzing markets on a risk reward basis, boiling it down to an area where the risk is very small and the outcome is much bigger. And that is simply it. You can read textbooks on trading and all of this. And what I try and do is reduce things to its smallest, risk for the biggest outcome. And certainly in this environment where markets are going up and going down, and the indexes are going up 1% an hour, up or down 1% an hour, or 2%. I've seen the markets make 3-4% moves in a day, and then individual stocks can go up 10 or 20%. So the thing is, if you have a global kind of worldview, and your market moves against you 20% in a day, you can be wiped out in between the time the market actually confirms what you were thinking. So the market is really about risk and reward. And what I try and do is, dial down these trades. I'll show you, some of the trades that I've got open now. So again, at the core, I'm a trader. I've been trading for decades. This is what I do. It's what I love to do. It's a personal challenge to see, if I can figure out where this thing's going and, and overlay my analysis on it and see if I'm correct. And so I started a pattern trader about 6 years ago, just as a way to give back all of this kind of knowledge that I've accumulated and, try and head you out of the market traps that I fell into many, many times. I blew out my account many times. And I decided to start this business to try and help people avoid some of the early mistakes I made. And so I'm going to show you some things. These are on live accounts, right? So I made probably, I don't even know what I probably made $150,000 or $200,000 today. Now, I know that sounds crazy. And I know automatically you're going to say, well, this is just another scammer. But first off, I have a worldwide audience. And then in the morning, I do a pre-market show called The Boiler Room, where I talk about all of the things that I'm looking at. I show our members on that, the moves that I'm making. And so I'm doing in real time before thousands of people, but I don't understand. We have a lot of people who come to us, who've been, scanned by other services and what have you. I'm a real trader, and whatever I'm telling you, I'm doing in real time. And I think that's kind of the difference. But, I'll let you make up your mind. I'm not going to try and sell you on anything. We have a review website. If you want to go and find out who I am, just go to Trustpilot, Mark Shawson. And there's 250 reviews there, and you can make up your own mind. Now, actually, before I go any further, I can hear that there's some lightning and thunderstorms out here. I live in South Florida, and we have a very fragile grid. So for any reason I get cut out in this presentation, it's not because I'm being rude. It's just, we are hostage to, extreme weather here. So with that said, let me just kind of plow forward, and then I'll take some questions. So again, these are from my live account. These are real as a heart attack. I don't know how you would create a demo for these kind of trades anyways, but I can assure you this is my personal trading account. This is one of them where I've got 250 call options of the stock called Bumble, BMBL, that expire in 2 weeks, and they're a strike price of 35. So that means this, price of this stock has to go north of 35 to make money. But you can see when, the market starts going, the options start picking up steam. So you can see that I've already made about 100% on my July 15 calls. So these expire June 17th. These expire in about 6 weeks. And I bought 200 of these, which means that the underlying is worth, this is a call, which is a bet on 20,000 shares. So you have to multiply this quantity times 100 because each call is based on 100 shares. So I paid about 85 cents for these calls, and they're trading at $2. So as of today, I've more than doubled my money in this call series. Now, this is extremely, extremely risky. I have to be willing to risk every dime of this money. And tomorrow, if the stock goes down $1, I could lose, 100% or 50% of the, the call value. Then I also last week bought some Uber call options, and you can see I was slightly in, in the black today. Uber was slightly higher. So these are the 25 call series, and I'll discuss why I did these. So the idea is not really to focus on whether I made money or lost money. What I'm going to do is explain a methodology that I use to assess various opportunities. Now, I'm going to share with you 2 or 3, setups today, and then I know I'm going to see, people wanting me to look at 100 different charts, and that's what, this is not what this is about. This is really an education forum for me to kind of, get you, just communicate a few of the ideas that I use. And then if you like it, then, you can obviously join with us and go further. So that was in Bumble and Uber. And then last week, I bought the stock of Alibaba, ticker symbol BABA. I bought 6,000 shares. And today it was up $6. So I'm up about $36,000 on this position. I also have a boatload of these Bumble calls that were up 100% today. And I have a boatload of these Bumble calls, and they were up a boatload today. And then I'm also long.
Mark,
yeah.
we're not seeing the chart anymore.
Did it cut out? Were you seeing it at all? Were you seeing it at all?
I was seeing it about 5 minutes ago.
Do you see it now?
Yep, there we go.
Okay, so let me go back. So these were my positions in one account. So I had 250 call options. That's, a bet on 25,000 shares of the June 17s. These were 200 calls, which is a bet on 20,000 shares of these calls, which expired July 15th. And you can see the last price today was $2, and I paid 85 cents for these. So I've made over 100%, on that move. And then I also have some call options on Uber. And again, don't look at the gains or the losses. I'm going to explain to you why I did it. And, it doesn't matter if it's a winning trade or losing trade. I don't know what's going to happen this week. The thing that I'm trying to communicate is a way of looking at the markets independent of, all of these, fluctuations and what have you. So in this other account of mine, I'm holding the stock of Alibaba, BABA. Dwight, are you seeing the screen now?
Yep.
Okay, so we are. Cool. So I have 6,000 shares of BABA. It was up $6 today. And so I made about 36 grand on that trade. I'm still in the stock, by the way. I've got a boatload of these Bumble calls. I'm way overloaded this stock. I started seeing this stock start bottoming out about 26, 27, and today it hit 32. So if you own the stock, it's a no-brainer. You can hold it, but any squiggle in the prices and these options get detonated. So it's a very dangerous game to play. It's really a game of chicken, and you can really get hurt. So you shouldn't put any more in the middle than you're willing to risk. And when I look at the size positions I'm in, I got to start paring it back. I've got a lot of risk in these things. This is in JD. I've got 3,000 shares of JD. It was up $4 today. And then I'm also long Uber calls in this account. I've got 250 calls. I don't know what I paid for them. I think like 45 cents, and they close at 66 cents. Uber was slightly higher today. And then I'm also long a Zoom video, ticker ZM, and it was up slightly today. So those are my stock and option positions. And then in the FX space, I've been long the pound yen, some euro yen, and I'm short some gold. And so far, these are open P&Ls. Tomorrow it could all be a loss. Who knows? But this is what I'm doing. I share with you what I'm doing and why I do it, and then we'll see how things work out. So I'm just going to share with you a couple of trades that I've done in the past, just to give you a flavor of what I say. I'm looking to capitalize on the big moves in the markets. So this was a trade, and this is the format of my email. So if you sign up for our service, our elite service, you'll get this email every day, alerting you to what I think is a formidable opportunity, a risk reward, opportunity. And so this particular trade was in the dollar versus the Japanese yen. Usually my markets, require the market to confirm what I'm looking at, but I felt this was so robust. I said, just slash and burn, buy this anywhere at 117.27. I said, dollar yen is broken out. I've been telling our members that this could be a once in a decade move in the yen pairs. And that's really what we're seeing. So I've been saying this for quite some while. Then at the same time, I said, buy the euro yen at 132. And cumulatively, these positions, made me a bunch of money. I took my profits. The yen trades, sold off, and then now I've recently reloaded them again. This was a trade in gold earlier, I guess in April, where I said, put a sell stop in gold at 1919 based on these patterns. So on my emails, I show you exactly what I'm looking at in the chart. And then I try and explain what I'm looking at in the analysis section. And then I do include a suggested trade. Whether you take this trade or not is entirely up to you. This is not a managed account system. It's not a signal system. It's really designed as an education. So what I show you what I'm looking at, and then we see if it works out. So the idea is whether it works out or not, you learn something. And frankly, I learned more from my losses. So if this didn't work out, I'd try and figure out, okay, what did I see? And then why did it go? And then I would learn for the next time. So I have a living archive now of a way of self-learning, if you will. And this is what I try and convey to our members. This was, I guess in the same period, gold had gone down to 1827. So it broke the 19. And so I made a whole bunch of money on gold going lower from 1900 all the way to 1815. And so this is in the pound New Zealand, where I put a buy stop in based on a setup that I was looking at the time at 192.77. It moved higher. So, most people will trade FX for 7 pips here, 15 pips here, what have you. I was up 700 pips in this pair. Not only did I not take it, I added to my position. So you could see in this analysis, I said, I'm currently long pound New Zealand at 192.77, and I'm looking to add to my position 700 pips higher. So this is kind of the difference, is that I looked at, take a piece out of these extraordinary moves. And this is what, can result if you're correct. And the idea is you don't have to be correct every day. If you just take chunks of the market out every once in a while, it ends up adding up. And so, we can go on and on. So instead of going on and on about my historical trades, I'll try and show you kind of why I put so much money. I mean, I've got hundreds of thousands of dollars, which is really kind of crazy, because I could be right, but my timing could be wrong and I could lose a lot of money. But I just saw this as, an extraordinary opportunity. Actually, what I'm what I'm going to do is I'm going to do a side by side and kind of share with you. Let me do the weekly. Okay. All right. So before I do that, let me just kind of dial right here. So you can see the screen, I'm assuming. Everybody can see the screen. I just like to confirm things so I don't keep going.
Yeah,
higher.
we can see.
Cool. So this was last February, so about a year and a half ago. I just saw this trade, and I was actually, just come out of a serious operation, and I was in my hotel room up in New Jersey recovering, and I said, look, I can't, put any stress on myself, but I've been waiting for this trade for months. It was in the stock Lyft. And sometimes something can de-risk itself by virtue of just how much time it takes to put that, that pattern together. So you can see that I had a buy stop in at $45.83. And I said, Lyft has formed a massive double bottom on the near term and the 3-year time frame. So both on the daily and the long term, I was seeing this huge bottom. And if a market's bottomed, by definition, it can only go one way. And so I thought it would go higher. And so, you can see in the footnotes, I said, I'm personally long Lyft common stock and the $46 call options. I also bought the $47 call options right around the same time. So I was really loaded on this stock, both in the stock and the options. And this is what happened. Now, unlike FX, which kind of gives you a clean P&L, my broker just, doesn't do that, just shows you my buy trade. So these are all the trades that I did in the stock. I was buying it at 45.68, 45.20, 46.57, 45.09, et cetera, et cetera. And I bought, 7,500 shares at $46, and I sold them at $58 and made $90,000 on the stock. But this is where, again, I do some option trades when I think the timing is right. Options are all about not only being right, but being right on the timing. So you can see I bought these $46 calls for 92 cents. And I blew them out at $7. So I made 760%. I put 650, but I was actually wrong. I sold them for 7, not 6. And I made 750% in 3 days. It went from 92 cents to $7. And then I also bought the $47 calls at $1.10, and I blew them out at 6. I made about 600% on that. So all told, between the stock and the options, I made a boatload of money on Lyft. Now, this is to me the value of charts. Markets are reoccurring. What happens in the past tends to happen in the future, and we can learn from that. So what I've done is I've overlaid the stock of BMBL that I'm currently got all of these options in with that of Lyft, LYFT. And I guess this is big enough. So again, I make these decisions and make literally hundreds of thousands of dollars purely on whatever I'm showing you right here. Nothing more. I don't know anything about the companies. I don't know anything about the cash flows, the balance sheets, the prospects for the future, on and on. And what you'll also notice is that this is what's called a clean or a naked chart, where you don't see any volume, you don't see any moving averages, you don't see any MACD, you don't see any Bollinger Bands. There are no leading indicators or lagging indicators. It's just this clean or this naked chart. And it's called a naked chart because I don't use any indicators. To me, I just look at a picture, a pattern. So to me, a market's either in an uptrend, a downtrend, or a sideways trend. But to my mind, there's also two other very important phases of the market. I call them phases of the market. One is where you could go from a downtrend to an uptrend, or from an uptrend to a downtrend. And before something turns, it always puts on some pattern. And if you can recognize the pattern, you can take advantage of that turn. So these are the 5 market conditions that I trade. And I trade all of them except this. I don't want to trade a market that's going nowhere. I want to make money on whatever I'm doing. I'm looking for market to go from one level to the other. So I'm not trading FX pairs for 7 pips or 20 pips every 15 minutes, waiting for it to come back in my face. To me, that's just a losing proposition. And you know, the only one who's going to win is your broker. So I'm just trying to take a piece of the middle out of robust moves. So if something's trending higher, I want to take a piece out of the middle. If something's turning, I want to take a piece out of the middle. And that's my philosophy, is that I just want to take a piece out of the middle. And so what we have here are 2 charts overlaid. Again, one is Bumble, BMBL, and the other is Lyft. Now, what I was looking at about a year ago was this weekly double bottom. You can see that, you know, this is exactly what it sounds like. The market kind of careens, makes a low, bounces, retests, and when it comes through what we call the neckline, it basically confirms that this is put in a bottom. You can see when it broke this neckline right here. So neckline is simply a line drawn through the entirety of the pattern. So you have one bottom here, you have one bottom there, and you have this W bottom. Now, we've done some scientific studies at the Pattern Trader, and we found that once a pattern is formed, you typically get 100 days of behavior. Now, remember, this is a weekly chart, you know, where the market will go higher for 100 days, not in a straight direction, but on balance for 100 days, it will end up higher than where it started. And so that's basically what happened. So this was really my entry, where you can see that after breaking out, it kind of put on this little resistance level here. And then it started selling off. But instead of being dissuaded, to my mind, you know, this sell-off represented an opportunity. So, you know, the thing that I look at is what I call the governing pattern. What is the governing or dictating pattern? And to me, that double bottom in this time frame was dictating. You know, here you got a little rounding bottom, you had a little thing, and you had this sell-off. But to me, this represented, you know, an enormous opportunity based on, you know, my global or macro view of what was going on here. So this is exactly where I bought this thing, right here, at that low. Now, on the weekly, it doesn't reveal itself, but there was a couple of indicators on the daily, and I bought it right there at $45, $46 on the stock. And I bought the options right here. I bought the $45 calls and the $46 calls. And by the end of the week, this thing closed at $53 and then subsequently went higher. Now, typically, you know, usually only buy these options a week in advance. My Bumble calls are like a couple of weeks in advance or a month in advance. And so these options, you know, expired here, and I ended up making 750% on those calls. But what I'm showing you here is what I perceived, and I shared with our, you know, members in the boiler room last week. And those, if there's anybody on this call, you know, of the boiler room, you know, I'd love you to corroborate, you know, this discussion. If anybody from the boiler room is on this, I guess they're not. So you can see here, we have the same situation. So Dick says, yes, he did. I was there. So Dick is a longtime member and a great supporter of the Pattern Trader. And Dick is basically saying that, you know, in here, when the stock was crashing last week, I said, this is where to buy it. And so why did I have so much faith? Every time this thing sold off, I was buying more and more calls. And that's why I have so many today. This thing just kept selling off. I just kept buying more. And now you can see it's on the high. So, you know, how did I know that? I didn't, but this pattern told me, again, this double bottom where it makes a low, bounces off the low, retests the low, and now comes through the neckline. And so now we have liftoff. Now it's broken through the neckline as it did here. And the problem is that, as it did here, this thing could also go into a 5 or 6 week slumber. So this is 1, 2, 3, 4, 5, 6, 7, 8 weeks. So that's 2 months. And if you got options that are expiring, that 2 months is a lifetime. So it's highly possible that this thing could break out and then go sideways for 2 months and then go again. But either way, I'm going to be waiting for it. I know what's going on here. And once I understand the game, they can give me sell-offs, they can give me whatever. But if I feel like I understand the game that's being played here, that's how you can make a lot of money. And I think if you bought the stock here and are willing to just sit on it for 3 to 6 months, you will very likely to make money. I mean, I don't want to say anything. There's no guarantees here. This is, everybody's a big boy, and, this is a game of risk. So this is the stock of BMBL. And so I think that this thing has bottomed. I don't care if we go into a recession. I don't care what the Fed says. And this is the difficulty when you have so many countervailing things. And the market today, I can't show you. I'll show you in a minute. The market dropped like a stone today. And, you've got to have the ability to, say, well, I'm looking at this. And despite the fact that the market's selling off, and this thing opened $2 higher in the morning and then crashed. And, when you're in options, I mean, your premiums just evaporate so quickly. But, this is where you kind of just got to play the long game and, play what this market's telling you. So this stock is starting to break out. And from this bottom, to my mind, it has bottomed. And I think 100 days from here, we will be at higher prices. And people always say, well, how can you hold on for these big moves? It's because the markets objectively tell me something. But if you're looking at your account, if you're looking at the squiggles every minute, there's no way you can hold on to these trades. The whole thing is to be very, very objective. And the market is, so we'll tell you where it wants to go. So just to put in, this is what happened in the market today. If you're looking at a short-term chart, this is what happened. So the market went straight lower. Meantime, bubble closed on the high for many, many weeks. So you can see how I'm not looking at the market when I'm playing Bumble. And this is why you have to be completely objective. I'm also in the euro versus the yen. Let me just actually take out some of these trades. So it doesn't matter if you're looking at an obscure stock like Bumble, or you're looking at gold, or you're looking at the euro yen. I am looking at everything in the same way, through the prism of price patterns and price action. And sometimes not so easy. Markets go in different directions. They give you different looks. Let me actually just start on the monthly. So what you'll notice is that I'm not opening up an hourly chart or a 4-hour or 15-minute chart. What I'm showing you here is a monthly chart that goes back 12 years. So all the way back to 2008. This is the euro versus the Japanese yen. I'm trying to get it to go bigger. I don't know why it's, there we go, maybe. Now I start losing sizing. Let me just, okay. So this is the euro yen on a monthly chart. Monthly. So each one of these price bars represents 1 month in time. So this is very different than looking at something on a 15-minute chart. My whole thing is, it's, to understand, you need you need to understand from a global view what's going on. And then obviously you can't time these things intricately on a monthly chart. If I see something, and I'll whittle it down to the weekly or the daily to find, you know, a more approximate risk reward setup. But what we're looking at on a multi-year chart, a long-term chart, and you can see how prices formed this perfectly formed symmetrical triangle. You know, if you were an architect, you couldn't, you know, draw this any better. And so, you know, these charts are telling you a story where there's accumulation, you know, where things have bottomed, and where there's a distribution, where there's an area of people selling. So again, I look at about a half a dozen patterns, you know, the double bottom, the double top, if you will. And actually what I'll do is I'm just going to put this in the chat box here. You guys can look at it. I was going to play a short video that explained this in detail, but we couldn't find it. So there's a strategy link that, you know, we'll share with you, you know, very familiar or common patterns. So you see the double top, or you see what looks like a man or woman's left shoulder. The peak is the head, and then you have a right shoulder. So this is called a head and shoulders pattern. And both the double bottom and the head and shoulders are reversal patterns, meaning that once you see these patterns, the market is going to reverse lower. And, you know, the converse is true. If you have a double bottom like Bumble, or you have an inverted head and shoulders, then this is going to be a bull market, a bottoming pattern. So you have topping patterns and bottoming patterns. And the thing is, the market will throw a lot of these things in the same area. And now you got to decide, what is the governing pattern? And so you can see that, you know, during this, you know, when you had lower highs, when this was in a downtrend, you saw a number of patterns. So this was your head and shoulders. And you can see after that was identified, you had a drop from 135 to 110. Effectively, you could have made $25,000 with a $1,000 bet just upon the recognition of that pattern. And then in this time frame, also along this downtrend line, you had another double bottom, a double top. And once you saw that, it dropped somewhat. But you can see that the markets play, you know, between, you know, bull and bear, and then they form one pattern, and then all of a sudden you formed another pattern. And so in this time frame, you got to say which one is ruling the roost, which is the governing pattern, this one or that one. And the way I kind of, you know, dig in the weeds here is I look at the price action. So I look at a combination of patterns and price action. I look to see what does price do at the juncture of the pattern. And you can see right here, we made a low for the week. And by the end of the week, we were much higher. And you can see that that price bar from low to high was much bigger than normal. So typically when something of consequence sticks out, you know, it points in the direction it wants to go. You can see there was another reversal right here where it made a new low and closed substantially the other way. So these bars, what I call key reversals, point in the direction that they want to go. And so now, you know, I advised our members that actually the risk in this trade is not being long. This thing is breaking out, and you can see that back in this time frame in 2008, when we had extraordinary financial conditions like we do today, you had this once in a decade move where it dropped from 170 to 105. You could have made 70 grand in 3 months just being short this thing. So, you know, I think that you could have a very extraordinary move here because you've basically broken out of this long-term channel where you've just been kind of going between the support and resistance. And you could see that for many years, this was making lower highs. So it was in this downtrend. But starting here and then here, you started to break the cadence where all of a sudden you started making higher highs. Instead of lower highs, you were making higher highs. And so you started breaking out above this long-term triangle right in here. You can see we started breaking out here. And then sometimes you get these false breakouts where you break out and then it's a trap and then it goes the other way. And so you don't really know that, but you know that when the market makes a new high. So you can see that when we broke out and snapped back, you broke above that high. And now you've recently done that again, where you basically broke out to there, you snap back, and now you're making new highs. So basically, in my mind, that's, it's not a fake out. This is real as a heart attack. And that, something in motion tends to stay in motion. And so, you're going to see a lot of turbulence in these yen pairs. You're going to get 200 or 300, 400 point swings all over the place. And so, again, I have a very different mindset and mentality to most traders in the FX. So if I think there's going to be this, once in a blue moon, move, it's going to make 1,000, 2,000 pips. I'm not in and out for 7 pips or 30 pips every 2 seconds. I'm looking to hold on to this thing. And so in order to do that, I need to give this thing room to move. You can see that these things, don't go vertical, without giving you some kind of, some kind of turbulence. And so, we're starting to clean above, certain areas. That's the last bit of resistance at 140 until we get to 150. So it looks like this thing really could just get real legs quickly. And I think the risk is not being long. So I'll get long and put like a 300 pip stop on this thing. And tomorrow, you say, well, there's no way I could take a 300 pip, stop loss. And that's true. If you trade your normal lot size, you can. But the whole thing is if you reduce your lot size, and I'm going to give you a calculator that'll tell you exactly what you need to, reduce your lot size for your given level of risk for your account size. But the whole thing is to focus on, a move in the market. And if you're in and out 5 times a day trying to bang this 7 pips here, 20 pips there, that is just not going to be a long, sustainable way to make money. And, that's not my opinion. Just look at the statistics in this business. 90% of people lose their money. And, I think there's a lot of reasons for it. But to my mind, the primary reason is that people are trading on too short a time frame and their outcomes are not big enough. Meaning that if you're trading for 15 pips profit, you more than likely, you got to risk 10 or 15 pips, to make that 15. Then, of course, you got to pay the 3, 4, 5 pips in the euro yen spread. So, if you're risking 15, you got to make 18 just to break even every time. And that's just a 1-to-1 outcome. So if it's like kind of going to the casino, right? You get in a hot streak, you're playing blackjack or whatever, and every time you put the chips in the middle, you either make whatever you think or you lose that. And eventually, the longer you sit at that table, the casino is going to win because of the spread. So you need to be right, 95% of the time, playing in and out game, 10 times a day. And, people are wondering why they end up with no money at the end of 3 months. It's a game of attrition. You can't win that game. So it's, to my mind, you have to have a bigger expectancy, meaning that I don't get in an FX trade unless I can make 150 pips, unless I can see some kind of pathway where I can see some kind of move where I can make at least 150 pips. I'm not even going to do it. It's not worth my time. I'm not sitting in front of the screen and wasting my time trying to, snag a trade before it's taken away from me. So, typically I would, risk 50 pips to make that 150 pips. But you can see now I have a 3-to-1 risk reward, which means if I win, I make 3 times what I lose. So the math will, tell you that you can actually lose 72% of your trades. So instead of being right on every trade, you can actually be wrong on most of your trades and still be a big winner. And then if you find one of these trades, once or twice a year that goes for, 500, 1,000 pips, that's where I make all of my money. So again, what I'm looking to do is capitalize on monster moves in the markets. I'm not in and out on some 15-minute time frame trying to just snatch, moves here and there. And so I'm looking for patterns that inform me how to get on these rides, whether it's a head and shoulders here and I hop on this ride and take a piece of the middle there, whether I get on a double top here and take a piece of the middle here, or I see a double bottom here and I take a piece of the middle here and then here and then hopefully here. Does that make sense? So Seelan says, I'm a newbie. Where do I start? We have what's called an elite service. This is the most premium thing that we do. After this 3-day webinar, you'll receive an email from our team asking you if you'd like to register. This is not something that you'll find on our website. It's by intent. We want you to talk with our representative, understand what it is. And this basically gives you everything that I do. I'm trying to find this email. So this was my email yesterday, right? So I said, buy the euro yen, but I also said, do this trade, right? I said, sell Illumina, ILMN at 235. This was yesterday. This was yesterday, went out yesterday. So if you're a newbie, basically I would send you an email every day that looks like this. I'll show you what I'm looking at and what I'm looking to do. In this case, it was buy the euro yen. In this case, it was sell a stock called ILMN. So if you're a newbie, basically I walk you through what I'm looking at and then suggest a trade. And then I also put the suggested trade parameters, risk 0.5%, 1%, depending how I'm feeling about it. So this was the stock of Illumina, and you would have been making $9 just today, from yesterday to today. You would have been up $9 in the stock. So I said, sell this at 235, and it's now at 226. So again, I don't want you to get carried away with, did these trades make money or not make money? This is in any given week, I may be losing, but the whole thing is the whole value that I'm trying to communicate is how to look at, and I have no idea what Illumina is, what it does, what its balance sheet is, what have you. I just make a certain assessment. I say, first off, what is the phase or condition of this market? And I talk as if I would have a 6-year-old here. And if I said, is this chart going up or is it going down? So it's gone from $520 to $220. So I think we could all agree this is in a down market. So once this is in a downtrend, all I'm looking to do is capitalize on what the market is telling me, capitalize on this downtrend, and then look for ways to get in on this trend. So again, within these down trades, you see these patterns. You see the head and shoulders. You see the head and shoulders. So you can see that all along the way, these things make patterns that you can recognize. And once you understand what the game is, like Bumble. So if Bumble goes up and then all of a sudden it comes back, I'll look for another pattern to get long again. So once you understand what the game is, then you just look for the patterns to get in sync with the game. And so, yesterday I saw this email. I said, we have this double top right down here, these two peaks. And then you had what I call an inside bar, where you can see the range of Friday basically sits within range of, so, what an inside bar is literally where the range of one bar, the high and low, sits within the range of the other. Now, all that's telling me is that, to me, this market is collecting energy. When it kind of just sits there within the range, this is what I call a coil. It's kind of it's building energy. And then, I'm deducing that the energy is going to break in the direction of the pattern and the trend. And in this case, I said that I don't usually say this. I usually kind of put stop orders, but I anticipated there may be a little rally in this. And so it was well timed. This thing went to about 238 today. I said, sell it at 235. And now we're at 226. And then people say, well, okay, where do you put the take profit? So what I do when I put on a trade is that, I'll put the take profit way away from this thing, because I want to see how this thing responds to what I'm looking at. And if it starts going, then I'm just going to let it work for me. And so, the first level of support is right around here at 207. So I think I put like a take profit at like 209. But if this thing starts coming out of here like a bat out of hell and looks like it's going to smoke through here, I'm not going to stop it from making me more money. I'll just move the take profit, lower and lower to take advantage of this downtrend. But again, this is just an example of how I look at what the market is telling me. I know nothing about this company. I'm not looking at whether the US is going to be in a recession. I'm not looking what Jay Powell said yesterday. I'm looking at just the risk reward. And to me, it's all about, finding a trade that is all bunched up where the risk is very small. So I deduce if I get here, my risk is, that big, and my reward is probably a lot higher. This thing, I think, looks like it's going to get cratered. This thing could probably go down 30% from here for this amount of risk. So that's what I do all the time. I'm looking at risk reward calculations. David says, when we see an inside bar, should we consider them as a confirmation? No, they're just part of a. So what I do is I first evaluate the phase or condition. In this case, it's a down. Then I, look for a pattern, head and shoulders or whatever. And then I look for what I call my insurance day bars. And that's just a phrase that I coined. If you hear it somewhere else, somebody stole it from me. I call this an insurance bar because, to me, when I see these, it tells me where to join a trade and what my risk is. So my definition of a insurance day bar is, number one, what I call a key reversal. Sorry about the bad printing. So you can see right here, I was kind of struggle to feel which is going to be a, anyhow. So right here, you can see this bar in that day made a new high. And by the end of the day, it closed on the low, like this. So by the end of the day, the sellers were in control in a market that's going lower in a pattern that is establishing itself as a head and shoulders top. So once I understand, so now I'm looking for this thing. I'm in a downtrend. I got this pattern. Now I'm going to look for the one bar that's going to, kind of get me in the cadence of this trend where I can join this trade. And then what I'll simply do is that I usually try and get the market to confirm what I'm looking at. So I'll just put a sell stop right underneath that low of that key reversal. And you can see, in the beginning of the day, it hardly went higher, dropped, put me in that trade. And that's the kind of trade you would have gotten out of there. So that's one definition of the key reversal. The second is what I call an inside bar. Now, if you're looking at a daily chart, it's an inside day bar. If it's a weekly chart, it's an inside week bar, month. It's just an inside bar. And so I'm trying to find, so you kind of have something like that here, where you could see this kind of snuck out a little bit, but mostly that was a range that was, in between, was in that. So to me, it's just a coiling. And so you could just put your stop and sell stop and get a nice trade out of there. This is an inside day right there, where you have this bar that's within, and then you had the key reversal in the previous day. And so I don't know how to respond when you say it's a confirmation. It's, so I'm looking at, a compilation of 5 different things. The phase of the condition, it's a down condition. Then do I have a chart, a chart. Then I look for the inside day bar, and then I set it up with a sell stop in a market I want to sell, or a buy stop in a market I want to buy. So I don't know if that's all clear. I'm going to give you a link to my book probably on Wednesday, and it'll probably make things a little bit clearer for you. Isaac says, will you be going through some other FX? So what I'm trying to do is just show you charts. It doesn't matter what the chart is. I'm trying to show you a way of breaking down an analysis. But if you don't know what I'm doing, I could go through all of these FX charts and then leave you, and then you won't know why I'm, what I'm really talking about. So it's really it's important. What I'm trying to do is get you communicate a way of breaking down and looking at anything. I don't care if this was corn, the euro yen, dollar yen, whatever it is. So I'm just going through some of the things I did, some of the things I've suggested as a way of looking at it. I can't go through everything. So, over the next 3 days, I'm sure, Isaac, I'll look at some other FX pairs. Nikki says, apart from the amount of pips you're targeting, what are the other downsides of trading in lower time frames? So the downside is, first off, you don't know the forest for the trees. Now, I'll give you a good example of this, right? This is a great example. So I'm in the stock Bumble, and I'm on, with my morning thing, and I'm, kind of celebrating. This thing opened higher. You can see that this little slash mark on the left, it opened substantially higher and then went higher, but then it crashed. So now this is, a daily time frame, where even this time frame really, I'd need kind of more, I'd kind of need a bigger thing. And so you can see on the daily now, this pattern. But if I showed you this on a 10-minute, now, let's, now you're looking at this thing on a 10-minute time frame. And, let's pretend that, we don't have any of these prices here. This actually this morning made a perfect double top. So if you're looking at this micro time frame, this is what you saw on the opening. You saw this thing go to make new highs and crash. Now your heart's in your stomach. I mean, this looks like, if you're looking at it on this time frame, this looks pretty extraordinary. Tell me that you would step in there and buy the crap out of it. You wouldn't, because you don't know the cards you're holding. So the problem is several-fold from trading on a short time frame. You don't know the cards you're holding. The market can go anywhere. It looks random. You can't tell this from the forest for the trees. The other thing is, it incentivizes you to overtrade. You're going to be making too many decisions, too many emotions, which means you're going to be making too many mistakes. I'd rather make one trade and sit in it for 3 weeks than make 5 trades a day and lose all my money. So show me one person who's made a lot of money trading in and out on a short time frame, because I've never met that person. And so look, it's just a style of trading, and I recognize that my way is not going to be comfortable for most people, because I will sit in a trade for 3 weeks or 3 months. If I was long this stock, I would never get out of it. I should be long instead of all these options, because this tells me what the deal is. So there were days last week where it opened higher and crashed, opened higher and crashed, opened higher and crashed. And every single day I bought into those lows. Every single day it broke lower, I just bought more and more and more calls. And so if you're just looking at this action, You say, well, it's at a resistance swing. There's all kinds of things here. And so that is the distraction. This to me is the distraction. This is the real game. And now it's here. But, again, if you're day trading or looking at it on the intraday, and, I had a heart attack on the opening. It's not friendly to see something, open, go higher and then crash. That's what it looked like, on a 10-minute chart. So how can you make a decision like that? You can't. So I recognize this is not for everybody, but to my mind, it's the only way you're going to make substantial money in the markets. And that's really the fundamental question you have to ask yourself. What are you really trying to do? What is your objective in trading? And everyone will say, well, of course I'm trying to make money. But then if you dial it down, the question, really, is it? Are you doing it to distract yourself, you amuse yourself, you get entertainment, you're a junkie, whatever it is. And I'm the same. I'm a trading junkie. I could trade, 5-minute bars, and I have, and I just find that it brings me nothing but tears. But I'm trying to focus, once in a while on making these extraordinary moves. And then it pays for all of my gambling addiction. All the stupid things that I'll do along the way. But, when I see something like this, like I saw in Lyft, it's, that's how, so it's not for everybody. Nikki says, absolutely makes sense. Thank you. You're welcome, Nikki. I just said, thank you. Yes, I guess I should have rephrased. Perhaps what I wanted to see was more examples of identifying patterns, especially on other pairs that are not that obvious. Well, the euro yen was not that obvious, man. That was, there were bullish patterns, there were bearish patterns. And, that was that's not an easy pair. But once it starts breaking out, once something starts showing you their hand, once this starts making new highs, now look, there will be resistance like right here, about $35, which is exactly where my strike and my call options are. So tomorrow, if this starts making a big move again, my time frame is very different because I got these call options that will expire on me. So if I'm making 200-300% on my calls at some point tomorrow, I'm going to start getting out of them, which doesn't mean that I'm negative on the stock. It's a money management. You got to take some money off the table. What else? So I also went long Zoom today, and I'll leave it here. I don't know if I'm going to be right on this one. It's very hard in this environment where I feel like the market is going to go down long term, and yet I'm long all of these things. And that's, the difficulty. The market has different time frames, when it's going to get there, etc. And sometimes it's difficult walking and chewing gum at the same time, meaning that my longer term horizon is that the market's going to come lower and perhaps substantially lower. But in the short term, we could have even a benign thing where it just doesn't go down a lot. Some of these really beaten down stocks, and Zoom was a stock that I've been telling our members to short since 500 a year and a half ago. But, I'm starting to see things on Zoom, ticker symbol ZM, that first off, we made a new low in this area. And now we're kind of going the other way. So anybody who sold these new lows that, put their sell stop and sold here is now losing. And this is what, could be what's called a bear trap, where all the bears chase us into a hole and then it comes out the other way. And then you get what's called a short covering squeeze, which means that all these guys who are short need to get out of their positions. And that's a whole other thing. But what I'm seeing here is, could be an Adam and Eve double bottom. So an Adam is where you have, a single thing, and then it bottoms, and then you have an Eve where you have multiple attempts at the same level, but it's still, whatever you want to call it, it's still a double bottom, an area where prices have come to a certain level and, you know, have bottomed and turned around. So the combination of this kind of what I, you know, think could be a bear trap, as well as a bottom down here, and you can see it kind of cleared this area, which is the neckline. And now you've had this coil where you've had 6 days of inside day bars. So this is building energy. And, you know, to my mind, it's, you know, the metaphor I always use is like a beach ball. You know, picture if you put your hand on top of a beach ball and push it further and further and further underwater, and then you took your hand off. What happens? The energy, the ball just uncorks and the energy just comes out. So this, to my mind, has been building energy. You know, it's still in a downtrend, but now I see this bottoming pattern. I see this energy. And so I bought it today. I bought it, you know, perhaps a little early. You should always, you know, confirm it. And what I would do is tomorrow, I would simply just stick in a buy stop here. And the nice thing about this is that you've got a small risk. So you could put in a buy stop here about 113.5, 114, and you could put your stop loss, you know, under the low here, and you could have a $7 risk, you know, for what could be a $30 move. You know, if this does come out of here, it could really uncork. You know, you can see that some of these short covering moves, you know, this went from 90 to 125 or 130. So these moves can be extraordinary, you know, if they pop out of here. So, but this is what I do. I try and confirm the trade. And tomorrow, if it opens and goes lower, then your buy stop is not triggered, and you have your cake and you can eat it too, where, you know, you thought something would happen, but you didn't get hurt. Dan says, what about bars that you like over candles? All right, I'll make that the last question because it is a good question. You know, maybe I'm just hostage to an old way of doing things, but I visually can see this chart and everything about it. When I kind of see these reversals, I just see them so clearly. Makes a new low, close at the high. Makes a new low, makes a new high, close at the low. So I can just see these reversals so clearly where, you know, if I'm looking at a candle chart, you know, it's just a different way of looking at things. And I just see these things so clearly where I can see the pattern and then I can see the reversals within the pattern. And this is just like kind of go to the bank. Then I see these, I just see these micro moves as I, you know, look at this chart. These reversals just stand out to me. Now this made a reversal the other way, made a new low and closed at the high. So this thing made an all-time new low for many years, but by the end of the day, it closed on the high. So it made a new low, but by the end of the day, the buyers were in control. And then, you know, you have this other kind of bottoming thing with no real price behavior, but it's this guy right here. So I look at a combination of how things close within the cadence of the trend and the pattern. And then sometimes, you know, the pattern and the trend will, you know, go the other way. And I'll do what's called a counter trend trade. So even if this thing went to 140 bucks, you know, that would be like a, you know, 100% move from here, but it'd still be down 80% from the highs. So the major trend is still lower, but that doesn't mean you're not going to get, you know, whole swaths of time where, you know, things move the other way. So, you know, horses for courses. I will take trends, you know, in whatever way, direction they'll reveal themselves or take me on some kind of ride. So I'm going to end it there, and I'll see you back tomorrow at 4:30 Eastern Standard Time. I'll share with you some stock and FX calculators that you can use to set up the risk on your trades. So thanks again for attending this. Hope you got some value out of this, and we'll keep breaking it apart. And the idea is for me just to share with you a way of looking at things that has nothing to do with, seeing what the next guy in a forum has to say,
Yeah,
or, yep. So thanks, everybody. Dwight, thanks a lot, and I'll see you back tomorrow.
All right, Mark. See you tomorrow.
Thanks, everybody. Thanks, Klaus. Appreciate it. Thanks, Roman.